Chapter 22, Master Budgets. A budget is a financial plan that managers use to coordinate a business's activities. Managers use budgets in fulfilling their major responsibilities. Exhibit 22.1 illustrates this process. First, strategies are developed. Overall business goals, such as a goal to expand international operations or a goal to be a value leader in one market while diversifying in other markets. Companies then plan and budget for specific actions to achieve those goals. The next step is to act, to carry out the plans. After acting, managers compare actual results with the budget and use the information to make controlled decisions. The feedback allows them to determine what, if any, corrective action to take. If, for example, the company spent more than expected in one area of operations, managers must cut other costs or they can increase revenues. These decisions then affect the company's future strategies and plans. Notice that the process is a loop. The control step is not an end, but rather an input into the step of developing strategies. Successful companies use current period results to help make decisions regarding the company's future. One benefit of budgeting is that it requires managers to plan for the company's future. Decisions are then based on this formalized plan, which helps prevent haphazard decision-making. Keep in mind, however, that budgets are plans for future activities and may need to be modified. Another benefit is that the budget coordinates a company's activities. Creating a budget facilitates coordination and communication by requiring managers at different levels and in different functions across the entire value chain to work together to make a single, unified, comprehensive plan for the business. A third benefit is that budgets provide a benchmark that motivates employees and helps managers evaluate performance. In most companies, part of the manager's performance evaluation depends on how actual results compare to the budget. This can be done through a performance report. Exhibit 22.3 illustrates a performance report for a service company. This report identifies variances, the areas where the actual results differed from the budget. Looking at the report, we see that actual service revenue was $11,000 less than budgeted service revenue. This was caused by two factors. The company was able to sell at a higher average price per service. The actual price per service is calculated as $31 per service, or $589,000 divided by 19,000 services, whereas the planned price was $30 per service, or $600,000 divided by 20,000 services. However, the company sold 1,000 fewer services than it planned to sell, 19,000 actual services less 20,000 budgeted services. The increase in price per service was not enough to make up for the decrease in the number of services sold. Variable expenses were less than budgeted for both server space expense and advertising expense, which creates a favorable variance. Actual server space expense was less than budgeted server space expense because the company sold 1,000 fewer services and because the company reduced the server space expense per service. It budgeted $2.25 per service budgeted, or $45,000 divided by 20,000 services. Its actual cost was $2 per service, or $38,000 divided by 19,000 services. Advertising expense remained constant at 5% of revenues, but due to the $11,000 reduction in revenues, advertising expense was $550 less, calculated as 11,000 multiplied by 5%. Actual fixed expenses were exactly the same as budgeted fixed expenses. Considering this company's fixed expenses, one wouldn't expect these to change unless the company changed the pay rate or number of employees, or unless the company negotiated a new contract with its internet service provider. The budgeting process varies from company to company. For a small company, the process may be relatively simple and somewhat informal. In larger companies, however, the process can be very complex. with the budget committee coordinating the process. To achieve the benefit of motivating employees, the budget should include input from all levels. This requires significant coordination among the company's various business segments. Therefore, the budgeting process usually begins several months before the beginning of the budget period. The most important part of a budgeting system is getting managers and employees to accept the budget so the company can reap the planning, coordination, and control benefits illustrated in Exhibit 22.1. Few people enjoy having their work monitored and evaluated. If managers use the budget as a benchmark to evaluate employees' performance, managers must first motivate employees to accept the budget's goals. Here's how they can do it. Managers must support the budget themselves, or no one else will. Managers must show employees how budgets can help them achieve better results. And managers must have employees participate in developing the budget so that employees feel the goals are realistic and achievable. Managers' performance is also evaluated by comparing actual results to the budget. When they develop the company's budget, they may be tempted to participate in budgetary gaming and build in budgetary slack. Budgetary slack occurs when managers intentionally understate expected revenues or overstate expected expenses. This increases the chance that actual performance will be better than the budget and that they will receive a good evaluation. But adding slack into the budget makes it less accurate and less useful for planning and control. Another budgetary game is referred to as spend it or lose it. In many companies, if a business segment has a budgeted expense item and does not spend as much as expected for this item, there is a fear the budgeted item will have a lower amount in future budget periods. For example, if the accounts payable department budget allows for $5,000 in supplies expense and the department only spends $3,000, then there is a fear the amount will be reduced to $3,000 in the next budget. The employees are then motivated to purchase unneeded supplies, which reduces the operating income for the company. For this try it, match the following statements to the appropriate budgeting objective or benefit: developing strategies, planning, acting, controlling, coordinating and communicating, and benchmarking. Managers are required to think about future business activities. Well, that's clearly planning. Number 2, managers use feedback to identify corrective action. Sounds like they're controlling in that instance. 3, managers use results to evaluate employees' performance. This is an example of benchmarking. 4, managers work with managers in other divisions. This is an example of coordinating and communicating. There are many different purposes for budgeting. Therefore, there are many different types of budgets. Let's look at some of the different types. First, we'll discuss strategic and operational budgets. A strategic budget is a long-term financial plan used to coordinate the activities needed to achieve the long-term goals of the company. Strategic budgets often span 3 to 10 years. Because of their longevity, they often are not as detailed as budgets for shorter periods. The term operational generally indicates a short-term goal. After the company develops strategies and creates a strategic budget, the next step is to plan for shorter periods. An operational budget is a short-term financial plan used to coordinate the activities needed to achieve the short-term goals of the company. Operational budgets are most often 1 year in length, but may also span only a week, maybe a month, a quarter, depending on the company's needs. Operational budgets are generally much more detailed than strategic budgets. Next, let's examine static and flexible budgets. A static budget is a budget prepared for only one level of sales volume. For example, Smart Touch Learning, the fictitious company we have used to illustrate accounting concepts throughout the book, may prepare a budget based on annual sales of 2,000 touchscreen tablet computers. All revenue and expense calculations would be based on sales of 2,000 tablets. A flexible budget is a budget prepared for various levels of sales volume. This type of budget is useful for for what-if analysis. Smart Touch Learning may expect to sell 2,000 tablet computers, but a flexible budget showing results for selling 1,600 tablets, 1,800, 2,000, 2,200, or 2,400 tablets allows managers to plan for various sales levels. Flexible budgets are covered in detail in the next chapter. The master budget, which is what we will be discussing in this chapter, is the set of budgeted financial statements and supporting schedules for the entire organization. Budgeted financial statements are financial statements based on budgeted amounts rather than actual amounts. The master budget is operational and static. Exhibit 22.3 shows the order in which managers prepare the components of the master budget for a manufacturing company such as Smart Touch Learning. The exhibit shows that the master budget includes three types of budgets: the operating budget, the capital expenditures budget, and the financial budget. The operating budget is the set of budgets that projects sales revenue, cost of goods sold, and selling and administrative expenses, all of which feed into the budgeted income statement that projects operating income for the period. The first component of the operating budget is the sales budget, the cornerstone of the master budget. Why? Because sales affect most other components of the master budget. The company will not produce products it does not expect to sell. Additionally, variable production and period costs are projected based on sales and production levels. Therefore, the sales budget is the first step in developing the master budget. The second type of budget is the capital expenditures budget. This budget presents the company's plan for purchasing property, plant, equipment, and other long-term assets. The third type of budget is the financial budget. The financial budget includes the cash budget and the budgeted financial statements. Prior components of the master budget provide information for the first element of the financial budget, the cash budget. The cash budget details how the business expects to go from the beginning cash balance to the desired ending cash balance and feeds into the budgeted balance sheet and the budgeted statement of cash flows. These budgeted financial statements look exactly like ordinary financial statements. The only difference is that they list budgeted or projected amounts rather than actual amounts. For this, try it, match the budget types to the definitions. First, we have budget type financial. If you look through all of those, that matches with letter F, which includes the budgeted financial. The next one we have is flexible. And if you look at that one, that matches to D, includes sales volumes. The next one that we have is operating. And you see that one matches to A, which includes sales, production, and budgets. Number 8 there is operational, which matches budgets. Then we have 9 static, which matches to C, level of sales volume. And then number 10 is strategic, which matches with B, budgets. To illustrate the preparation of the master budget, we use the fictitious company Smart Touch Learning. As you recall, the company manufactures its own brand of touchscreen tablet computers that are preloaded with the company's e-learning software. The master budget is for 2017, prepared by quarter. The balance sheet for December 31st, 2016, as shown in Exhibit 22.4, provides some of the data we use in preparing the master budget. The first step in preparing the master budget is the sales budget. The forecast of sales revenue is the cornerstone of the master budget because the level of sales affects expenses and almost all other elements of the master budget. The sales and marketing teams at Smart Touch Learning project that the company will sell 500 tablet computers in the first quarter of 2017, with sales increasing by 50 tablets each quarter. The tablets sell for $500 each. Exhibit 22.5 shows the sales budget for Smart Touch Learning for 2017. Budgeted total sales for each product equals the sales price multiplied by the expected number of units sold. The total sales for the year will be carried to the budgeted income statement. Next, we will prepare the production budget. The production budget determines the number of tablets to be produced during the year and is the basis for the production costs budgets, which are direct materials budget, direct labor budget, and manufacturing overhead budget. Additionally, the information is used to complete the cost of goods sold budget. Let's look at the formula we will use to prepare the production budget. To calculate the number of tablets to be produced, start with the number of tablets projected to be sold. Add to this amount the desired number of tablets for ending finished goods inventory to calculate the total number of tablets needed. Keep in mind that Smart Touch Learning does not want to end the period with zero inventory. It wants to have enough tablets on hand to begin the next period. The company should have the minimum amount of inventory to be sure the company balances providing goods to customers with turning over the inventory efficiently. Keeping inventory at the minimum level that meets these needs helps reduce inventory storage costs, insurance costs, and warehousing costs, and it reduces the potential for inventory to become obsolete. After determining the number of tablets needed, subtract the number of tablets already on hand and beginning finished goods inventory. The difference is the number of tablets to be produced. The following data is needed to prepare the production budget for Smart Touch Learning. The December 31st, 2016 balance sheet for Smart Touch Learning, shown in Exhibit 22.4, indicates the finished good inventory account has a balance of $55,000, which consists of 200 tablets at a cost of $275 each. The company desires to have an ending inventory each quarter equal to 20% of the next quarter's sales. Assume the projected tablets to be sold during the first quarter of 2018 is 700 tablets. 50 tablets more than the fourth quarter of 2018. Before we can prepare the production budget, we must compute the ending finished goods inventory for each quarter. The ending inventory is needed in the calculation of the number of tablets to be produced. As stated in the data for Smart Touch Learning, the company desires to have an ending finished goods inventory that is equal to 20% of the next quarter's sales. Now that we have calculated the ending inventory for each quarter, we can prepare the production budget. Exhibit 22.6 illustrates the production budget for Smart Touch Learning. Note that one period's ending inventory becomes the next period's beginning inventory. Smart Touch Learning has determined the number of tablets to be produced each quarter. The next step is to determine the production costs for the tablets, beginning with direct materials costs. The company must estimate the direct materials cost per unit. Then the company needs to determine the amount of materials to purchase each quarter. The amount of indirect materials needed for the production of tablet computers has been determined to be insignificant and will therefore not be considered in the calculation. That means that the amount of materials in the raw materials inventory account is assumed to be only direct materials. Just as the finished goods inventory account must be considered when calculating the amount of tablets to produce, the raw materials inventory account must be considered when calculating the amount of materials to be purchased. The number of units to be produced is multiplied by the direct materials cost per unit to determine the direct materials needed for production. Direct materials needed for production plus the desired ending inventory gives us the total direct materials needed. By then subtracting the direct materials in ending inventory, we arrive at the budgeted purchases of direct materials. The following data is needed to prepare the direct materials budget for Smart Touch Learning. The December 31st, 2016 balance sheet in Exhibit 22.4 places the raw materials inventory balance at $30,000. Desired ending raw materials inventory is 40% of the next quarter's production needs. The desired ending balance for the fourth quarter is $42,600. The purchasing department has projected that the cost of direct materials is $150 per unit. Before we can prepare the direct materials budget, we must compute the ending raw materials inventory for each quarter. The ending inventory is needed in the calculation of purchases of direct material. As stated in the data for Smart Touch Learning, the company desires to have an ending inventory that is equal to 40% of the next quarter's production, and the cost of direct materials is $150 per unit. Now that we have calculated the ending raw materials inventory for each quarter, we can prepare the direct materials budget. Exhibit 22-7 illustrates the direct materials budget for Smart Touch Learning. As with the production budget, note that one period's ending inventory becomes the next period's beginning inventory. The next production cost to consider is direct labor. The production manager projects that each tablet computer will require 3 hours of direct labor. The personnel manager projects direct labor costs to average $25 per hour. Exhibit 22H shows the direct labor budget for Smart Touch Learning for 2017. To calculate the direct labor cost, multiply the number of tablets to be produced by the number of projected direct labor hours. Then multiply that total by the average direct cost per hour. Here's the data for the manufacturing overhead budget. Variable manufacturing costs, $20 per tablet. Projected fixed costs, $12,000 per quarter for depreciation on manufacturing equipment, $15,440 per quarter for other fixed costs. Direct labor hours are used as the allocation base. As a reminder, the formula to calculate the predetermined overhead allocation rate is calculated as total estimated overhead costs divided by total estimated quantity of the overhead allocation base. Exhibit 22-9 shows the manufacturing overhead budget for Smart Touch Learning for 2017. Now that the production costs have been determined, Smart Touch Learning's managers can use them to complete the cost of goods sold budget. Start by calculating the projected cost to produce each tablet in 2017. The total projected manufacturing cost to produce each tablet in 2017 is $294, which is calculated as $150 in direct materials, $75 in direct labor, and $69 in manufacturing overhead. The cost of goods sold budget for Smart Touch Learning for 2017 is shown in Exhibit 2210. Let's examine how it was prepared. Smart Touch Learning uses the first in, first out FIFO inventory costing method. Recall that the production budget illustrated in Exhibit 22.6 shows that the company starts 2017 with 200 tablets in finished goods inventory, and the balance sheet in Exhibit 22.4 shows the beginning finished goods inventory has a total cost of $55,000. All other tablets sold in 2017 will assume a production cost of $294 per tablet, as we just calculated previously. Referring to the sales budget in Exhibit 22-5, the company projected sales of 500 tablets in the first quarter. Therefore, using FIFO, 200 tablets will be assigned the beginning inventory costs of $55,000, and the remaining 300 tablets will be assigned the cost of $294 per tablet. Next, we will look at how to prepare the selling and administrative expense budget. First, we start with a projection of the selling and administrative costs. The supplies expense is a variable cost that needs to be calculated. To do this, we multiply the sales revenue for each quarter as calculated in the sales budget in Exhibit 22-5 by 1%. The completed selling and administrative expense budget for Smart Touch Learning for 2017 is shown in Exhibit 2211. For this try-it, Kendall Company projects 2015 first quarter sales to be $10,000 and increase by 5% per quarter. Determine the projected sales for 2015 by quarter and in total. Round out answers to the nearest dollar. So we take first quarter sales, multiply each quarter by 5%, add them all up, and that's what we come out with, $43,101. Number 12, Friedman Company manufactures and sells bicycles. A popular model is the XC. The company expects to sell 1,500 XCs in 2014 and 1,800 XCs in 2015. At the beginning of 2014, Friedman has 350 XCs in finished goods inventory and desires to have 10% of the next year's sales available at the end of the year. How many XCs will Friedman need to produce in 2014? How they set that one up. Budgeted XCs to be sold, 1,500. How many we want in ending inventory? 180. So add those two together and we get the total that we need, which is 1,680. Then we just subtract out what we had to begin with in the beginning inventory of 350, leaving us with 1,330 to be produced. Capital expenditures are purchases of long-term assets, such as delivery trucks, computer systems, office furniture, and manufacturing equipment. The decision to purchase these expensive long-term assets is part of a strategic plan, and this decision-making process is covered in detail in a later chapter. For now, we will assume Smart Touch Learning plans to purchase additional manufacturing equipment on January 2nd, 2017. The equipment will cost $160,000 and will be paid in 2 equal installments during the first and second quarters of 2017. The installment payments will be included in the cash budget. The next step in preparing the master budget is to prepare the financial budget, which include the cash budget and the budgeted financial statements, the budgeted income statement, the budgeted balance sheet, and the budgeted statement of cash flows. The cash budget pulls information from the other budgets previously prepared and has 3 sections: cash receipts, cash payments, and short-term financing. The primary source of cash is from customers. The sales budget is illustrated in Exhibit 22.5 shows the projected sales by quarter. Smart Touch Learning projects that 30% of the sales will be cash sales, which indicates cash will be collected immediately. The remaining 70% of the sales are expected to be on account. The company expects to collect 60% of the credit sales in the quarter of the sale and 40% in the quarter following the sale. Bad debt expense is not significant and therefore is not considered in the budgeting process. The balance sheet in Exhibit 22-4 for December 31st, 2016 shows accounts receivable has a balance of $70,000, and this amount is expected to be collected in the first quarter of 2017. Exhibit 22.12 shows the calculations for cash receipts from customers. The total cash receipts from customers for each quarter will be carried to the cash budget. The December 31st, 2017 balance in accounts receivable will be carried to the budgeted balance sheet. Smart Touch Learning has cash payments for capital expenditures, product costs, direct materials purchases, direct labor costs, and manufacturing overhead costs, and selling and administrative expenses. Therefore, the calculations for cash payments require reference to several previously developed budgets. Recall that Exhibit 22-7 showed the purchase of direct materials. This information, along with the following data, is needed to calculate the cash payments for direct materials. We will assume that all direct materials purchases are on account, and Smart Touch Learning projects payments will be 75% in the quarter of the purchase and 25% in the quarter following the purchase. Reference to the December 31st, 2016 balance sheet shown previously in Exhibit 22.4 indicates accounts payable has a balance of $20,000. This amount will be paid in the first quarter of 2017. Exhibit 22-13 shows the calculations for cash payments. The calculation of cash payments for direct materials uses information from the direct materials budget shown in Exhibit 22-7. All direct materials purchases are on account, and Smart Touch Learning projects payments will be 75% in the quarter of the purchase and 25% in the quarter following the purchase. Reference to the December 31st, 2016 balance sheet shown in Exhibit 22-4 indicates accounts payable has a balance of $20,000. This amount will be paid in the first quarter of 2017. The information for cash payments for direct labor come from Exhibit 22-8. Smart Touch Learning pays direct labor costs in the quarter incurred. The information for cash payments for manufacturing overhead come from Exhibit 22-9. Smart Touch Learning makes cash payments for these costs in the quarter incurred. Keep in mind that we are calculating cash payments. Therefore, non-cash expenses are not included in the cash budget. The most common non-cash expense is depreciation. The cash outflow for long-term assets, such as manufacturing equipment, is at the time of the purchase. Depreciation is the allocation of the asset cost to an expense account over the life of the asset. The allocation does not affect cash and is not included in the cash budget. We use Exhibit 22-11 to determine the cash payments for selling and administrative expenses, which Smart Touch Learning pays in a quarter incurred. Again, be sure non-cash expenses, such as the depreciation on the office equipment, are not included in the cash budget. Other cash payments include items such as income tax expense. The financial accountant at Smart Touch Learning has projected income tax expense to be $70,000 for the year. Payments will be made in 4 equal installments during the 4 quarters. Cash payments for capital expenditures include the manufacturing equipment purchased on January 2, 2014 for $160,000 that will be paid in 2 $80,000 installments in the first and second quarters of 2017. Note that the total cash payments for each quarter will be carried to the cash budget. The December 31, 2017 balance in accounts payable will be carried to the budgeted balance sheet. Next, in order to prepare the cash budget, we need information on the short-term financing that is available to Smart Touch Learning. The December 31, 2016 balance sheet, shown in Exhibit 22-4, shows cash as a balance of $15,000. Smart Touch Learning's financial accountant recommends maintaining a larger cash balance in the future. The recommended minimum cash balance for 2017 is $30,000. The company has arranged short-term financing through a local bank. The company borrows cash as needed at the beginning of each quarter, in increments of $1,000. In order to maintain the minimum cash balance, interest is paid on any outstanding principal balance at the beginning of the following quarter at 3% per quarter. Repayments on the principal balance are also made at the beginning of the quarter in increments of $1,000 as cash is available. Now that we've compiled the information needed for cash receipts and cash payments, let's insert those amounts into the cash budget so that we can determine the amount of short-term financing needed during 2017. Exhibit 22-14 shows the partially completed cash budget for 2017. Notice that the cash payment for interest expense for the first quarter is $0. The December 31, 2016 balance sheet from Exhibit 22-5 does not show notes payable or interest payable as liabilities. Therefore, no interest is owed at the beginning of the first quarter of 2017. Exhibit 22-14 shows a cash balance before financing of negative $15,715, which is the cash available of $265,000 less the cash payments of $280,715. This amount is less than the minimum cash balance desired and creates a cash deficiency of $45,715. The ending cash balance before financing plus total effects of financing will equal the ending cash balance. Exhibit 22-14 showed an ending cash balance before financing of negative $15,715. As shown in the partially completed cash budget in Exhibit 22-14, Smart Touch has a cash deficiency of $45,715 for the first quarter. The company borrows funds in increments of $1,000, so the amount to be borrowed is $46,000. Smart Touch Learning will then have an ending cash balance for the first quarter of $30,285. The ending cash balance for the first quarter then becomes the beginning cash balance for the second quarter. Exhibit 22-15 shows the cash budget completed for the first quarter. The amount borrowed at the beginning of the first quarter accrued interest during the quarter and must be paid at the beginning of the second quarter. The formula to calculate the interest expense is the principal multiplied by the rate multiplied by time. For Smart Touch Learning's second quarter, the interest expense is $1,380. When the interest payment is recorded for the second quarter, it is determined that Smart Touch Learning again has a cash deficiency and must borrow funds to maintain the minimum cash balance of $30,000. Carefully examine Exhibit 22-16, which shows the first and second quarters after financing and the third quarter before financing. We again need to calculate the interest expense in the third quarter. Smart Touch Learning's third quarter, the interest expense is $2,640. After the third quarter interest payment is calculated and the ending cash balance before financing is determined, Smart Touch Learning shows a projected cash excess for the third quarter as shown in Exhibit 22-17. The cash excess can be used to repay a portion of the amount previously borrowed, again in increments of $1,000. Exhibit 22-17 shows the completed cash budget. And then here is the 2017 fourth quarter interest expense of $1,230. Note that the principal repayment in the fourth quarter is only $41,000, even though the company has $60,590 in excess cash. At the beginning of the fourth quarter, the balance on the note is $41,000, which is the total of the amounts borrowed in the first and second quarters, less the repayment made in the third quarter. In other words, $46,000 plus $42,000 less $47,000. Smart Touch Learning will only repay what has been borrowed and now has excess cash to be used for other purposes. Also, pay special attention to the total column of the cash budget. You cannot simply add across each row to determine these amounts because this is a summary for the entire year. For example, the beginning cash balance for the year is the same as the beginning cash balance for the first quarter, but not the sum of the beginning balances for each quarter. The budgeted financial statements are the next step in the budgeting process, and the cash budget provides several amounts needed. The interest expense calculations are carried to the budgeted income statement, and ending cash balance is carried to the budgeted balance sheet. Smart Touch Learning repaid all amounts borrowed during the year. If those amounts had not been repaid in full, the balance would be carried to the budgeted balance sheet as the balance for the notes payable. Smart Touch Learning has now determined all amounts needed to calculate the budgeted net income for 2017. Following is a summary of the sources of these figures. Exhibit 22-18 shows the budgeted income statement for Smart Touch Learning for the year ended December 31st, 2017. Budgeted balance sheet for Smart Touch Learning for December 31st, 2017 will pull amounts from the various budgets previously completed. One remaining calculation is for retained earnings. Retained earnings is increased by the amount of net income earned and decreased by the amount of dividends declared. The net income is shown in Exhibit 22-18, and the company does not project dividends for the year. A summary of the sources for the balance sheet figures is below. Take the time to look at each exhibit reference to ensure you know where each figure came from. The budgeted balance sheet for Smart Touch Learning for December 31st, 2017 is shown in Exhibit 22-19. Keep in mind that the balance sheet only shows the ending balances of each account as of December 31st, 2017. The last step in the preparation of the master budget is the budgeted statement of cash flows. The information comes from the cash budget illustrated in Exhibit 22-17. All cash receipts and disbursements are designated as operating activities, investing activities, or financing activities. The direct method is used and illustrated in Exhibit 22-20. For this triad, Meeks Company has the following sales for the first quarter of 2015. Sales on account are collected the month after the sale. The accounts receivable balance on January 1st is $12,500. The amount of December sales on account. Calculate the cash receipts from customers for the first 3 months of 2015. Exhibits 22.5 through 22.20 show that managers must prepare many calculations to develop the master budget for small companies such as Smart Touch Learning. Technology makes it more cost-effective for managers to conduct sensitivity analysis and combine individual unit budgets to create the company-wide master budget. The master budget models the company's planned activities. Actual results, however, often differ from plans. Management, therefore, wants to know how budgeted income and cash flows would change if key assumptions turned out to be incorrect. We previously defined sensitivity analysis as a what-if technique that asks what a result would be if a predicted amount is not achieved or if an underlying assumption changes. Many companies use computer spreadsheet programs like Excel to prepare master budget schedules and statements. Today, what-if budget questions are easily answered within Excel with a few keystrokes. Companies with multiple business segments must combine the budget data from each of the segments to prepare the company-wide budgeted financial statements. This process can be difficult for companies whose business segments use different spreadsheets to prepare the budgets. Companies often turn to budget management software to solve the problem. Often designed as a component of the company's enterprise resource planning system, this software helps managers develop and analyze budgets. Software also allows managers to conduct sensitivity analysis on their own segment's data. When the manager is satisfied with his or her budget, he or she can easily enter it in the company-wide budget. His or her segment's budget automatically integrates with budgets from all other business segments, from around the building, around the state, around the country, or even around the world. Whether at headquarters or on the road, top executives can log into the budget system through the internet and conduct their own sensitivity analysis on individual business segments' budgets or on the company-wide budget. The result is that managers spend less time compiling and summarizing data and more time analyzing and making decisions that ensure that the budget leads the company to achieve its strategic goals. For the last try it, Crowley Company projects the following sales. Crowley collects sales on account in the month after the sale. The accounts receivable balance on January 1 is $13,500, which represents December's sales on account. Crowley projects the following cash receipts from customers. Recalculate sales and cash receipts from customers if total sales remain the same but cash sales are only 20% of the total. And here is what that would look like.